Welcome to the Hurst Trading Room. My name is David Hickson and this is a video update for the 8th of December 2014. As always, before we take a look at the markets, please make sure that you have read and understood these disclaimers. If you are watching this video anywhere other than our podcast channel, the Hurst Trading Room now has a podcast channel, which is very exciting, then make sure that you subscribe to our podcast channel, because that way you will be notified immediately of any new Hurst Trading Room videos that we produce. That means you can watch the video or listen to the audio using whatever device you like to use to consume your podcasts. You can also share the Hurst Trading Room with friends. So subscribe to the Hurst Trading Room podcast channel on YouTube. There is a link there, http://0s4, that is a 0, not a capital O, 0s4.com/r/HTR for Hurst Trading Room. And if the word subscription sends cold shivers down your spine, you needn't worry, subscription is free. You don't need to pay for anything. So please subscribe to the Hurst Trading Room podcast channel. That way you'll be notified as soon as I produce a video. Let's take a look at the markets. And in last week's video, I spoke about the S&P 500 and I presented the long-term picture. I spoke about the fact that the stock markets around the world, and I used the S&P 500 as my example, stock markets around the world are moving up towards a peak of a 9-year cycle. So that's obviously going to be a momentous event. The fact that markets are heading up towards a 9-year cycle peak does not mean that I am bearish. I'd like to make that clear. As the markets are moving up, of course, we enjoy the bullish momentum and we keep a close eye on the bull that is driving that market, and we enjoy bullish long trades. The fact that we know that a peak of the 9-year cycle is approaching does not mean that we have turned bearish yet. Obviously, at some point I will be turning bearish, and I suspect that we're going to be in for a rather nasty ride to the downside when that 9-year cycle peak has formed in the markets. But in the meantime, we definitely enjoy the bullish momentum of the upwards movement. Now, I spoke last week about the 20-day FLD and how price was coming down to the 20-day FLD, and how once it crossed below that 20-day FLD, I expected it to remain below that line until the formation of the 80-day cycle trough. In an effort to keep these videos short, I perhaps glossed over some of the details, and I think it's time for me to explain those details, because the details are very important. So let's take a look at what we're speaking about here. This is the S&P 500, and as you can see, there was a trough of the 18-month cycle on the 15th of November, I believe, either 15th of October, I beg your pardon, 15th of October 2014. That was an 18-month cycle. 18-month. And of course, the market has been bouncing upwards very strongly ever since then. The formation of an 18-month cycle trough in the markets means that all cycles of 18 months and shorter are, of course, bouncing up. And so you expect a good bullish move out of there. I spoke last week about how the next big event, and obviously big event depends on your time frame. For somebody who's trading intraday, a daily cycle or a 12-hour cycle might be a big event. But in terms of looking forward over a period of the next month or two, the next big event is this 80-day cycle trough, which you can see is expected here. Now, this is what's called a nest of lows. These circles with lines to each side of them represent the next expected time of a trough for those various cycles. Of course, the cycles are color-coded. You can see that the longest cycle in that nest of is the 80-day cycle, and I've drawn an inverted triangle there which represents the range of time in which the 80-day cycle trough is expected to form. Of course, you must remember that troughs form synchronously according to Hurst cyclic principles, and so when the 80-day cycle trough forms, there will also be a trough of all cycles shorter. In other words, the 40-day cycle, the 20-day cycle, 10-day, 5-day, and of course all the intraday cycles as well, will be forming troughs at exactly the same time in the market. And that is why we end up with an inverted triangle like that, a pyramid standing on its head, if you like. As you can see, that nest of lows is centered around the week of Christmas, the week of the 22nd of December, and so that is when we expect the 80-day cycle trough to form. Now, there are many subtleties to bear in mind when you are analyzing the markets using Hurst cycles, and so I would like to spend this video speaking about some of those subtleties. I am also going to be taking a look at stock markets from around the world. I'm going to take a look at some European markets, and I'm going to discuss similarities and differences between those markets and the US markets, because, of course, stock markets around the world tend to move with a great deal in common. That is called Hurst's principle of commonality, and it's a very important thing. So when things get a little bit confusing in one particular market, it's very useful to look at another market. I'm going to be doing that in today's video so that we can come up with a summary of exactly what is happening in stock markets generally around the world. Of course, there will be differences from one market to the next. So, as I've pointed out, the next major event is a trough of the 80-day cycle. So if I was to draw a very simple cycle here, then you see, of course, it bounces out of the 18-month cycle trough, and then it will come down into the 80-day cycle trough, at which point it will bounce up. Now, the fact that we have identified that the 80-day cycle is going to form a trough in about 2 or 3 weeks' time means two things. First of all, it means that we expect generally that the markets will be moving down into that 80-day cycle trough. I'm going to come back to that point because there are some very important details to that. It doesn't necessarily mean that you must enter into short trades. That's an important point. But generally, we are expecting markets to move down into the 80-day cycle trough. The other thing that this tells us is that we expect the market to bounce upwards out of that 80-day cycle trough. And so those are the two important pieces of information that we gather from the fact that we are expecting an 80-day cycle trough to form in a few weeks' time. First of all, we're expecting markets generally to move downwards. Then we're expecting markets to move upwards. That implies that we have two potential trading opportunities. The one is a short trading opportunity as the market moves down into that 80-day cycle trough. Of course, the other opportunity is the opportunity that will come in 2 or 3 weeks' time after the market bounces out of that 80-day cycle trough. We are looking at a long trading opportunity. Let's speak for a moment about those two trading opportunities. I've already mentioned that the market is moving up towards a peak of the 9-year cycle. So when you're considering two trading opportunities, a short one and then a long one, which one are you most interested in? Probably, I would suggest you're most interested in the long trading opportunity. The bull has been alive and well in this market, in stock markets around the world. It has been forcing stock markets up to new highs. So the fact that we are expecting an 80-day cycle trough in a few weeks' time does not necessarily mean that you must jump into a short trade. Probably the trading opportunity that you are most interested in is going to be the move out of that 80-day cycle trough. It's an important point. When trading using Hurst cycles, you don't necessarily take every single trading opportunity that comes your way. Hurst cycles gives you an insight into what the markets are doing. It tells you what to expect, and you need to take that insight and apply it to your trading. If you want to jump in and out of the markets very nimbly and get in for a quick short trade, then you might consider the short trading opportunity, because yes, there probably will be a short trading opportunity. It might not be a very good one, and I'm going to spend a moment discussing why that might be just now, but more likely is that you are looking forward to the long trading opportunity as markets bounce out of that 80-day cycle trough. And so that's a really important point. I'm not saying in this video that we must all jump into short trades, but what I am saying in this video is that we have two trading opportunities. possibly a short trading opportunity coming up now, although it might not be a very good one, but we are going to have another trading opportunity coming up in a few weeks' time, which is to enter long into stock markets to catch the move out of the 80-day cycle trough. And all the signs indicate that that is going to be a profitable trading opportunity. A bounce out of an 80-day cycle trough is usually a fairly good bounce. An 80-day cycle trough comes around once every 10 weeks, and so we expect it to be a fairly good long trading opportunity. So if somebody's thinking about buying you some stocks for Christmas, that might be a really good time to do it. But now let's turn our attention to some of the subtleties here. The first thing is that I spoke last week about once price crosses down below the 20-day FLD, and this purple line is the 20-day FLD. And FLD stands for Future Line of Demarcation. It is one of the tools that Hurst wrote, and the system doesn't want me to write it. There we go. It's one of the tools that Hurst defined, and it's a very useful line, and it's a very important line. As you can see, it is projected into the future. That's why it's called the Future Line of Demarcation, and it gives us information about what the market is expected to do in the future. As I mentioned last week, once price crosses down below this line, we expect it to remain below the line until the formation of the 80-day cycle trough. So here's that nest of lows for the 80-day cycle trough. Once price drops down below the line, we expect it to remain below that line until the formation of the 80-day cycle trough. Now, there's a very important subtlety that I didn't mention last week, but you should know that in order for a price cross below the FLD to count, it has to be median price. That's the mid price between the high price and the low price of the bar. Median price must cross below the FLD in order for the price cross to count, if you like. The FLD is a very powerful line. You'll notice that the markets respect that line tremendously. And it's not unusual at all to see what happened last week, which is that price came down to the FLD, and then it tracked along the FLD. Can you see that on Monday, Tuesday, Wednesday, Thursday, and even possibly on Friday, price had its high price above, or at least each bar of the price movement had its high price above the FLD and its low price below the FLD. We call that tracking along the FLD. It is something that often happens. And so price has not yet crossed down below the FLD. If we take a look at median price, you will notice that price potentially did just dip below the FLD. There's median price. So that orange line is the median price, the mid price between the high price and the low price of each and every bar. And you can see that it just dropped down by the below the FLD, but only by a very tiny amount. And so it doesn't really qualify as a good, clear cross. A purist might argue that that does qualify as a cross below the FLD, but I believe that one needs to give the markets a little bit of leeway. Markets aren't perfect, and that tiny move down below the FLD isn't really good enough for me. When we take a look at some of the other markets, you might decide that that does qualify as a cross, because in some of the European markets, price did indeed cross below the FLD last week. But I tend to take things like this with a pinch of salt. I give the market a little bit of leeway. And so I don't think that that price has properly crossed down below the FLD. I do expect it to cross down below the FLD because under most circumstances, price will form its 80-day cycle trough below the 20-day FLD. Now, so that's one detail, is that we expect median price to cross down below the FLD. And as you can see, I'm recording this video on Monday morning European time, and so the American markets haven't opened yet. But in overnight trading, you can see price has already come right down to the level of that FLD. There it is there. It's right at the level of the FLD. Is price going to cross down below the FLD today? Well, it might do, but we don't know that yet. So it's very important not to jump to conclusions and say, oh, price has crossed down below the FLD when it hasn't necessarily. But the important point is that once price does cross down below that 20-day FLD, and it almost certainly will before the formation of the 80-day cycle trough, once it does cross down below that FLD, we don't expect it to cross back up above the FLD before the formation of the 80-day cycle trough. So that's an important point. Now, there's another subtlety here and another very important thing that I think is worth highlighting. And it has to do with one's perception of what cycles do in markets. And let me just clear this and draw you another diagram. Most people, when they first come to a cycle understanding or a cyclic understanding of how markets work, they tend to think that because you have a cycle that forms troughs and peaks in the markets, they tend to think that a cycle will cause price to move up for about half the cycle and then move down for about half the cycle. Now, that is true. Cycles influence price to move up for about half the cycle, and then they influence price to move down for about half the cycle. But the shapes that are formed in the price movement as a result of the cycle are not symmetrical, perfect up and down shapes. And there's a very good reason for that. It's because there are multiple cycles that are influencing price to move up and move down and so on. And so you don't end up with perfectly symmetrical cycles in the price movement. You end up with very distorted cycles. Let me give you an example. On this chart, you can see a 40-day cycle, and the 40-day cycle trough formed, of course, synchronously here on the 15th of October. Then the next 40-day cycle trough formed on the 17th of November. So if I was to draw a semicircle representing that cycle, that would be it there. That's a very wobbly semicircle, but that's what the cycle is doing to price. It's influencing it to move up, and then, of course, it's influencing it to move down. But what happened in price over that time? Well, let's find our 40-day cycle trough in the price movement. There it is over there. What happened to price? Price moved up, and it kept moving up, had a bit of a wobble, moved up to a peak over here, and then it moved down for all of 2 days plus a weekend, so a total of perhaps 4 days. Do you see how skew that 40-day cycle is in the price movement? The first thing you have to do when you approach markets using Hurst cycles is you have to put out of your mind the idea that because a cycle is moving down to a trough, the price is going to be moving down for half of the cycle length. As you can see, price moved up for a very long period of time. In fact, we'll count the number of bars, and then it moved down for only 4 bars. Okay, let's do that counting now. We can count those bars. So in that 40-day cycle, price moved up for 29 days, right? Then it moved down for only 4 days. So the 40-day cycle influenced price to behave in a certain way, but its influence to cause price to move down was not very strong. Why is that? That's because of the other cycles that are influencing price movement. And that's where the concept of underlying trend comes in. Underlying trend is the combined effect of all cycles longer than the cycle that you are considering. So we were considering a 40-day cycle in this little example, and the underlying trend of that 40-day cycle consisted of all the cycles longer than that 40-day cycle. The 80-day cycle, in fact, let me display some semicircles here because semicircles make it very easy to visualize these cycles, although most of them are going off the chart there. But what you do is you take a look at the semicircle. So here's the semicircle for the 80-day cycle, and here's the semicircle for the 20-week, 40-week, and 18-month. Look at them. They're all going up. Okay. So that's 4 cycles that are going up. So the underlying trend for that 40-day cycle was +4. That's a really strong underlying trend. Why am I speaking about all of this? Well, because I've highlighted in this video and in last video the fact that price is moving down into an 80-day cycle trough. Does that mean that you must immediately jump into short trades? No, not necessarily, because the fact that the 80-day cycle is moving down into a trough doesn't necessarily mean that price itself is going to start plunging down. We do expect some downward movement. It might resolve itself into little more than a sort of a sideways movement. So how do we approach this? I've mentioned that we can't expect a completely symmetrical cycle, and it might only be going down for a short period of time. What do we expect? Well, the first thing that we do is we take a look at the underlying trend of the 80-day cycle to get some idea of exactly how bullish this 80-day cycle shape is going to be and how much of a downwards move we're going to get into the 80-day cycle. What is the underlying trend of this 80-day cycle? Well, we look at all the cycles longer than the 80-day cycle, starting with the 20-week, which is of course moving up. 20-week cycle is still moving up. 40-day cycle is moving up. So that's +1 for 40 days as well. And the 18-month cycle is also moving up. That's +1 for the 18-month cycle. So our underlying trend for the 80-day cycle is +3. Now, that is a positive underlying trend. But we noticed that the underlying trend of the 40-day cycle that I looked at was +4. So it was a stronger, more bullish underlying trend for the 40-day cycle. And that gave us a 5-day downward movement at the end of the cycle. +3 is less bullish. So I would expect slightly more of a downward movement. And so although I don't expect a really strong move down into this 80-day cycle trough, I do expect a move down. And the important thing is that once price crosses below the 20-day FLD, which it hasn't, in my opinion, done yet, but once it crosses down below that 20-day FLD, we expect it to remain below the FLD until the formation of the 80-day cycle trough. I hope that this is making sense to you and that the details are not confusing you, but instead shedding a little bit more light on what we're expecting. So I'm expecting a move down into the 80-day cycle trough. If you are keen on entering trades and exiting them within fairly short periods of time, then there might be a short trading opportunity approaching. There is definitely a short trading opportunity approaching. The question is it a good enough trading opportunity? If you're into getting in and out of markets fairly quickly, you'd like to make a quick trade between now and Christmas, then yes, it could be a profitable short trading opportunity. But more likely, the better trading opportunity will be the long trading opportunity that should be happening as price bounces out of the 80-day cycle trough. Now, let's take a look at one other important piece of information that we have, if you like, in terms of the formation of the 80-day cycle. And that is the 40-day VTL. Now, there's an important thing about VTLs. A VTL is the other cyclic tool that Hurst defined. VTL stands for valid trend line. It is a simple trend line that joins two troughs or two peaks, and it is validated by obeying certain rules. I won't bother you with all the details here. That information is all available in our learning material on the Academy, but a valid trend line is an important tool. And a valid trend line provides us with some important information, not about the cycle that it is based upon, but about the cycle 1 degree longer. Let me not dwell on that, but the important point is that once price crosses below a VTL, and in this example I'm showing you the VTL of the 40-day cycle, once price crosses down below the 40-day cycle VTL, we have evidence that a peak of the next longer cycle has formed in the market. Do you notice something? Here is the 40-day cycle VTL, and I'm not going to dwell on how it's drawn and everything. Just accept the fact that that is the 40-day cycle VTL. Once price crosses down below that 40-day cycle VTL, we have evidence that the 80-day cycle peak has formed in the market. Do you notice where price is today? It is below that 40-day VTL. Oops, that's a very skew arrow. But the price so far today is below the 40-day VTL. Again, there's a subtlety. Median price must cross below the VTL for it to count. And I'm recording this video on Monday morning. What we're seeing there is after our trading, or before our trading, if you like. The US markets haven't opened yet. We need to let the markets play out for the duration of today, and then have a look at median price for today's bar before we can say with confidence that the 40-day cycle VTL has been penetrated to the downside. But I'm giving you advance notice, if you like. It looks as if their price is on the verge of crossing down below that 40-day VTL. What does that mean? It means that the peak of the 80-day cycle has formed in the markets. Where is that peak? Well, it would be at last week's high, which was on Friday, I think I'm correct in saying. That's an extremely skew arrow. It doesn't really help at all. But there was a peak in the markets last week on Friday. And if price drops down below the 40-day cycle VTL this week, then we have evidence that the peak has formed in the market, and therefore that peak is the highest price that we are going to see in the current 80-day cycle. What's that telling us? It's telling us the same thing as price dropping down below the FLD, which is that effectively we have seen the peak of the 80-day cycle, and price is on its way down to the 80-day cycle trough, and therefore the current move is the move down to the 80-day cycle trough. The next move is going to be the bounce out of the 80-day cycle trough. Gosh, it's taken me ages to explain the subtleties on the chart of the S&P 500. I would really like to show you some of the other markets. So let's quickly go through them and speak about a few differences and a few similarities. Here is the Dow Jones Industrial Average. Let me turn off some of these VTLs that don't really apply. The Dow Jones Industrial Average, a very, very similar situation to what is happening in the S&P 500. And if we take a look at the line on median chart, you will notice that median price didn't quite cross down below that 20-day FLD. Well, if you have extremely good eyes, it might have dropped down by about a quarter of a point, perhaps. But effectively, the median price came down to the FLD last week, that 20-day FLD. If I can settle my mouse on it, there we go. It came down to that FLD and bounced back up again. So it hasn't yet crossed down below that FLD, the 20-day FLD. However, price is on the verge of crossing down below the 40-day VTL. So the Dow Jones chart is telling us the same thing, that price is about to confirm that the peak in the 80-day cycle has formed in the market, and therefore price is on its way down to the trough, and then of course we'll have the bounce out again. But bear in mind, it hasn't crossed down below that 40-day VTL yet. Okay, please don't take the before-hour trading that's happened on Monday morning as an indication of what's really happening in the markets. It can be very unreliable. The markets might still bounce back up again and stay above that 40-day VTL. So keep an eye on that 40-day VTL, and before you take as confirmed the 80-day cycle peak in the markets. Let's have a look at the NASDAQ quickly. Here you can see a very similar story, but a slightly different one. And that is why I think it is really useful to take a look at different markets, because some of them tell identical stories and some of them tell slightly different stories. Let's have a look at the similarities and the differences here. First of all, of course, you can see that the NASDAQ is also expecting an 80-day cycle trough to occur sometime in the week of about the 22nd of December. That's a rough projection, and I won't make this video any longer than it needs to be by discussing that. Perhaps next week I'll spend a little more time speaking about how accurate are those projections for troughs, but that'll be a subject for next week. What has happened in this market? Well, as you can see, the 40-day VTL, which is this blue dashed line, was crossed last week, on Monday of last week. What did that tell us? That told us that the peak of the 80-day cycle had already formed in the market. And that was on the previous Friday. What was the date then? That was the end of November, the last Friday of November. And so in the NASDAQ, we had confirmation last week that the peak of the 80-day cycle had formed. Do you notice something interesting? It's a subtlety, but it's an important subtlety. The NASDAQ did not reach new highs last week. However, the S&P 500 and the Dow did. And the difference, of course, is that price in the NASDAQ crossed down below the 40-day cycle VTL, giving us confirmation that that 80-day cycle peak had already formed. The NASDAQ is on the verge of crossing down below the 20-day FLD today. In after hour trading or before hour trading, so far on Monday the 8th of December, price has crossed down below that 20-day FLD. Don't take it seriously yet. Wait until the median price crosses down below the FLD before we have confirmation. But it certainly looks as if though the NASDAQ is on its way down to the 80-day cycle trough, after which, of course, it will bounce back up again. Now let's take a look very quickly at some European markets. Let's first of all look at the DAX. Now here is, let me just clear this FLD. You can see that the cycles have been clearer in the DAX than they have been in the US markets. There's been a much clearer price movement, and let's have a look at the 20-day FLD and the 40-day VTL, and you can see that the basic analysis is the same. An 18-month cycle trough formed over here in the middle of October, and we had a 40-day cycle trough which formed very nicely and clearly on the 17th of November. And the next big event, if you like, is this 80-day cycle trough. We've got a very neat nest of lows, which is projecting an 80-day cycle trough 1 week earlier than the US markets. So that warns us to potentially expect this 80-day cycle trough even slightly earlier. What happened last week? Well, you can see price came down to the 20-day FLD. Median price did not cross below that 20-day FLD. We'll take a look at that in a moment, but take my word for it, it didn't cross down below the 20-day FLD. So we are still expecting price to cross down below that 20-day FLD before it really moves down into the 80-day cycle trough. Time is running out, but remember, we can have very distorted, unbalanced cycles. We might have a move down of only a few days into the 80-day cycle trough. It's an important point. Hopefully it's a subtlety that I have managed to drive home in the course of today's video. But certainly we are expecting the DAX also to come down into an 80-day cycle trough and then to bounce up again. Let's quickly take a look at median price on the DAX, and you can see there how the median price did not cross down below the 20-day FLD. Right, let's take a look at how about the EURO STOXX? That is also the European market. It is very largely driven by the DAX, of course, so there's not really anything particularly worth saying here. We've got a very similar analysis. You can see price came down, touched the 20-day FLD. Median price did not cross below the 20-day FLD. Here is the 80-day cycle trough expected slightly towards the end of the week of the 15th of December. But the important point is that we are expecting price to come down into the 80-day cycle trough and then to bounce up again. And let's take a look at the FTSE. The FTSE is a very interesting market to take a look at, and let's see, let me just zoom in slightly and clear some of these FLDs. We don't want to get confused by too much information, and there we go. Now here you can see that last week on Monday price crossed down below the 20-day FLD, exactly as it did in the NASDAQ. Now that was a good clean cross down below the FLD, and then price bounced back up to the FLD, spent the whole of last week tracking along the FLD, and now has ended up almost by accident above the FLD, simply because over the weekend the FLD dropped down and price now finds itself by default, without having really done anything, it finds itself back up above the FLD again. Now, when that happens, I don't take that cross up above the FLD too seriously. This is a good, genuine cross down below the FLD that happened last week on Monday. That is an F category interaction as a matter of interest, as price comes down below the FLD. Coming back up to the FLD is something that you often see. Price didn't manage to cross back up above it until this morning, but I believe that is either simply price returning to the FLD, which is something that often happens, or perhaps an early example of a G category interaction. I certainly expect this price cross down below the 20-day FLD to mean that price has started its journey down towards the 80-day cycle trough. There is where the 80-day cycle trough is expected. Also, sometime around about the 20th, 22nd of December, towards the end of December, middle to end of December. And price has started its journey down towards that 80-day cycle trough. Why isn't price plunging down towards that 80-day cycle trough? Remember that the underlying trend is positive, and so therefore the move down into the 80-day cycle trough might be a disappointing move. It might be a matter of price fiddling around, dropping a little bit, pretty much moving sideways. The FTSE, as you can see, has moved net sideways for about 2.5 weeks so far. And so that sideways move might be all that it's going to give us for the move down into the 80-day cycle trough. Or we might see a little bit of a pickup of speed to the downside as the 80-day cycle trough is formed in the markets. And then, of course, the next good trading opportunity is almost certainly going to be the bounce out of that 80-day cycle trough. Thank you very much for joining me in the Hurst Trading Room today. I look forward to seeing you next week, and I wish you, as always, profitable trading.